something that's missing in the market. I know also from talking to you that you felt that some of the traditional forms of investing or handling illiquid assets like angel investing and other things are kind of broken. One of the themes of strategy, of course, is responding to where there's an opportunity. How did you look upon that? You didn't have any trouble raising money yourself, obviously. But.
Yeah, well, it certainly helps when you're profitable and you get, a lot of press. I think the breakdown in the capital formation process, I think there's a real fundamental problem here that a lot of people, I don't think, are not recognizing. And it kind of comes down to the lack of exits and the lack of an IPO market. And so when I say kind of the breakdown in the capital formation process, what I mean is, historically it used to be, if you want to raise money as a startup, you would do an angel round, maybe your friends and family, you do an angel round, a few venture rounds, and then you'd go public or you'd do a sale. And that was usually about 5 or 6 years. So the numbers now show it's taking, on average, about 10 or 11 years to go public. And so if you think about that, that doesn't work for anybody in the ecosystem. It doesn't work for angels. It doesn't work for employees. It doesn't work for venture funds. Because you can't hire an employee and say, okay, I'm going to give you 50% of what you're worth in cash compensation and give you a bunch of options, but you got to wait 12 years to monetize it. So what's happening right now is you're seeing a lot of companies not being able to raise money. You see venture investing down. You see angel investing down. And you see companies that are being sold that really should not have been sold. And so when the IPO market does reopen, the question is what companies are going to be eligible to go public? Well, the truth is the past 10 years have shown you're going to have to be a $500 million company or more. And if you look at the companies that went public in the 80s and the 90s, it was companies like Yahoo and Dell and Intel and Genentech that did a $10 or $20 million raise and had a $100, $200 million market cap. Think about what would have happened if any of those companies had actually been bought out. Yahoo being bought out by whoever was around then.
Well, and SecondMarket to the rescue, in that you're getting a lot of attention these days for the market that you're making in private company stocks, or the stocks of companies like Facebook, for instance, that haven't had a liquidity event so far. How does that work, and how do you bring buyers and sellers together in that asset class?
We got involved on the private company front actually well before we actually launched the market. It was probably late 2007, early 2008. We got a phone call from a Facebook, I guess, former employee who had some stock, who was wherever else, and said, I want to sell my stock. I know you guys have this platform for trading in liquid assets. Can you help me out? And we said, cool. It's Facebook. We all use it. So let's figure it out if we can do something. And to our surprise, a lot of people bid on it and bid competitively and like a good valuation. So we said, okay, well, let's consider this as a new asset class. And the funny thing is, and this is probably not surprising, but it became viral. That Facebook employee told his buddies, who told their buddies, and all of a sudden we had a viral marketplace that got formed on SecondMarket, which is great. But we were saying, Facebook is a very unique situation. Facebook is probably the most exciting private company out there. A lot of public information. It's easy to come up with a value. It's easy to buy that stock. So we spent really a full year out talking with venture capitalists and lawyers and entrepreneurs, saying, what's going on here? Is there a need for a market, for a private company market? And this was kind of when we figured out that IPO timeframe was becoming 7, 8, 9, 10, 11, 12 years. And we said, well, wait a second. There's a gap that exists here that never existed before. You used to go public after 5 years. Now you have years 6 through 10, 6 through 12 that never existed. So how are we going to address that? And that's why we launched this market.
So tell us a little bit more about how does it work?
Okay.
Where do you get the stock, and who sells it, and how do you make money on that?
So we our approach is actually very company friendly. So what we realized over that year of, I guess, diligence was that you really can't create a market in private company stock without the company's involvement. And involvement can kind of take one of a number of different forms. In the case of Facebook does not publicly acknowledge our existence. They do not endorse us publicly, but Facebook has to be involved in every single transaction. And so we've probably done maybe 100 transactions in Facebook, half of which were just in the past couple months. So that's one end of the spectrum. The other end of the spectrum is companies that are fully engaged with us, because what we offer to these companies is complete control. So we allow the company to decide who gets to sell, when they can sell, how much they can sell. They get to decide who the buyers are. They can decide what the price is that they want to. They can say it's set to the option strike price. They could say it's set to whatever. And the companies also get to control how much information is shared with the buyers. It's all done in our platform in a controlled environment. And so what basically happens is the company tells their shareholders, hey, if you want to sell some stock, we're going to allow our employees to sell 10% of the stock, and we're going to do this one time a year. Or other companies say, you know what? Go to second market, sell to your heart's content, but we're not going to be involved in the process. And it's kind of the beauty of the network effect. And we now have, it's funny, we had 9,000 registered users on Sunday, and then CNBC did something on Monday, and we had 1,000 new users sign up. So in one day, our entire membership base increased by 10%. And so it's the network effect. It's growing very quickly and it's becoming very viral. And the beauty of it is all the spreads are tightening, there's competitive bidding, and we're now seeing activity in Facebook and Zynga and Twitter and LinkedIn and all the exciting private companies. And what we're able to do now is allow these companies to stay private longer. We're allowing them to essentially grow to the point where they can go public, do want to go public, or in some cases, our company included, enable these companies to stay private forever, and afford your employees and your shareholders some liquidity.
Who are the buyers, typically? I mean, and you haven't just set up a cardboard box underneath a buttonwood tree here. There must be more to that in terms of bringing buyers and sellers together.
So the buyers, to get into second market, the regulations require buyers to be what's called an accredited investor, which I think you have to make a couple $100,000 a year, or an institution. So it's not retail. It's not unsophisticated investors buying. Tends to be institutions, tends to be venture capital firms are buying now, hedge funds, other types of asset managers. And of the 10,000 that have signed up, we're actually seeing a lot of overseas buyers coming in now.
Interesting. One of the lessons of the strategy revolution, it argues that strategy is actually a modern creation. It is not true that companies have always had strategies going back to J.P. Morgan or the contractors who built the pyramids. But it is a new framework that people didn't have before, which brings together, lets them look in an integrated way at three things: their costs, their competitors, and their customers. Now, you have some nascent competitors, or do you have competitors, or who are they likely to be, and how do you feel that you're going to deal with them?
So Second Market's vision is to create the global platform for liquidity. So we're in 7 asset classes now. We've got plans to get into, we have literally 80 on our list right now. So there's no one else out there that's trying to do that. I mean, whether you want to call it eBay or NASDAQ, whatever, a central, transparent marketplace. So within each asset class, however, we're going to have competition. It will range from, Goldman Sachs trading mortgage-backed securities to, websites that are creating bulletin boards for limited partnership interests. But, I think our model, what we figured out was that the solution here, it's not technology, nor is it people. It's a combination of both. We have very much a hybrid marketplace.
That's so interesting. You can say that the history of strategy falls into 3 periods, each of about 20 years. The first 20 years was about positioning, where were you on the experience curve or in a growth share matrix. The second 20 years, from about 80 to 2000, was around processes, time-based competition, business process reengineering. Now the argument is that going forward, process or strategy increasingly has to be centered on people. Because people will be the source of the kind of innovation that you have. There's no asset that you can really buy, or that somebody else can't buy or process, but you can have talent that you draw upon for innovation and creation of new things. What kind of in that regard, what have you learned as a manager and leader at the head of Second Market over the time that you've been creating this? Are you a different kind of executive than you were when you started out?
I think I have an employee or two here, so they can answer that question.
Yes, speak up, and if he speaks something untruth, then yell out.
So I've had 2 real jobs in my life. I was an investment banker at Houlihan Lokey, and then I was CEO of this company. And I think I've learned a few things. I think when I was an investment banker, I think I was an asshole. Because you go
that would
through
be unheard of on the investment banking community. Yeah, right.
Because when you kind of go through the investment banking kind of training program, I mean, it's like a fraternity, and people senior to you, they worked hard, so that you have to work hard, and look, I loved it, and it was a tremendous experience. But the people that trained me, they tended to they were just really hard workers, and they managed a certain way. And so that kind of shaped my management style initially. But I got feedback, during reviews that, yeah, you're great, you're really efficient, but you're kind of an asshole. And so it wasn't that bad, I don't think. But so when I started this
you had certain
company,
developmental opportunities.
Yeah.
So